And my next guest says the slide isn't over yet. Marko Papic is chief strategist at BCA Research. Marko, been eager to check in with you with everything that's happened geopolitically and otherwise the past couple of weeks. But let's start with some of these market moves. The long end, not looking at, U.S. Treasuries, obviously the U.K., I don't know if you want to get into that. Those bond rates moving higher with some concern about the budget bill. How would you describe the signals that we are being sent here from financial markets?
Well, Kelly, the bond market has known roughly what's in the bill for a while now, and it has still come down from 4.8% to basically 4.2% for much of this year. So I'm not sure that investors should expect a massive bond bearish environment, especially with the jobs report suggesting that there's plenty of reason for the Fed to both cut rates and for the economy to slow down. And so I think that the focus on fiscal viability of the U.S. is a little bit overstated. This bill is going to increase the deficit slightly over the next 10 years. But if you actually factor in some of the revenue from tariffs, it's not even clear that it's really going to move the deficit that much. Now, the deficit is very high, but the bond market is extracting a tax on the economy already for that.
What makes us different from the UK?
Well, I think what makes the U.S. different from the UK is that there is a much wider international appetite for bonds, obviously provided that the trade negotiations proceed along the current trajectory. And that's why your mention of Vietnam is relevant, because obviously President Trump starts engaging in warfare with the rest of the world. It's unlikely that the rest of the world is going to continue to use U.S. treasuries as a form of a safe haven asset. The other issue is that the U.S. has actually started to move towards some fiscal consolidation. And I know that most of your viewers will light themselves on fire when they hear me say that, because the consensus out there is that the U.S. remains very profligate. However, if you actually go back to last year and you quantify President Trump's campaign promises, they were about $10 to $15 trillion into the deficit, additional. But what we actually got with the one big beautiful bill, which I would rename one marginally, sizable bill, what we actually got is significant cuts, which he did not campaign on. We've got a consumption tax, which is at 10% across the board tariff. And actually, when you look at where the deficit widens, the biggest item is the $4.5 trillion cost to extend the 2017 tax cut, which is not really stimulative anyways.
Well, I mean, it's certainly better than taxes going higher. I mean, that is you know what I mean? Like that. And I understand why they're doing it, but that there is a price tag associated with that.
Yes, there is. The point is, though, it's not really stimulative, the kind of stimulus we've seen over the last 5 years, which is actually unprecedented in U.S. history. The U.S. spent as much post the pandemic as it did fighting World War II. It also did 4 times more than any other major economy in the world. And so that fiscal gravy train is over, and the bond market has already responded to that deceleration. Now, you might say, well, America is still speeding. You should still get a speeding ticket. Yes, but it's not speeding 200 miles an hour. It's speeding 10 miles over the speed limit. And so the bond market has already adjusted to that reality. And a lot of investors, they're not really focusing on this marginal rate of change, the second order effect. They're focusing on the absolute. They raise up their hands and say, look, deficits are high. I want to be short bonds. I think that will be a mistake.
So if you would say maybe in other words, falling bond yields is the better trade here, you think the dollar's weakness continues. Is all of this, as Katerina Simonetti yesterday suggested when asked about the exact same patterns, I said, why are both of these things happening? She said, it feels like a market pushing for rate cuts.
Absolutely. The market is absolutely pushing for rate cuts. President Trump is pushing for rate cuts. And the labor market is pushing for rate cuts. And this is why it's very dangerous to be very bearish right now. Dollar decline tends to not be negative for the economy. It's actually stimulative. Oil prices. Well, we didn't get $150 oil. Now, did we? In fact, oil price risk premium lasted as long as the life cycle of a fruit fly. So you've got low oil prices, you've got cheap dollar, and then finally, you have the fact that the Fed has 450 basis points worth of cuts to potentially enact. And that's something that I think we all need to sort of remember. There's a lot that they can cut, and I think they will get very aggressive. Yeah. And if Jay Powell doesn't get aggressive, then the shadow chair will, and that's what the market will respond to. It's going to respond to the next guy, not the one that's actually in charge.